Why lenders love self-storage. And self-storage has become a significant commercial real estate asset class for investors and also a property type that many commercial lenders understand and will actively finance. But why, you may be asking? Well, a performing self-storage facility can combine diversified rental income with relatively efficient operations and recurring demand and flexible rental rates and tangible real estate collateral. When those characteristics are supported by strong market fundamentals and experienced ownership, the result can be an attractive commercial lending opportunity. And for investors that are considering a self storage acquisition or a refinance or a construction project or a value add strategy, understanding why lenders like self storage can help you structure a stronger financing request. And diversified income can reduce tenant concentration risk. And one of the first advantages that lenders may see in self storage is the diversification of the rent roll. So consider a commercial property that's occupied by, say, one major tenant. And if that tenant leaves, the property's income could potentially decline dramatically or go to zero. Whereas in a self storage facility, you may have hundreds or even thousands of individual units. So losing several customers doesn't necessarily eliminate a significant percentage of the property's income. And that diversification can reduce tenant concentration risk, which is an important consideration that lenders evaluate when they're looking at the stability of commercial real estate cash flow. Self storage can generate consistent cash flow, and that's what everybody likes about it. And commercial real estate lenders are ultimately lending against the borrower's ability to repay the debt. And for an income producing property like this, that means lenders pay close attention to net operating income and the resulting debt service coverage ratio for the loan that they're going to make you. So when underwriting self-storage financing, lenders are going to evaluate what does historical occupancy look like, and is it economic versus physical occupancy, and what's the unit mix, and what are your rental rates, and do you have to offer concessions and discounts to make deals work, or any accounts in delinquent or collection status? What are your operating expenses, and what's the net operating income, and what is the debt service coverage ratio from there? But they'll also look at historical financial statements and the local market supply and what's coming online with construction pipeline, but also the borrower's experience and their liquidity and net worth. And a stabilized facility is going to demonstrate reliable occupancy and sustainable net operating income, but also present a compelling credit profile. And self-storage can have a really efficient operating model. And self-storage is not necessarily a passive investment, but modern technology has made many facilities increasingly efficient to operate. And operators can use online leasing and automated payments, electronic access control, and remote security systems, and a centralized call center with digital marketing and revenue management software. So compared with certain other commercial property types, there may also be fewer tenant improvement obligations and less complicated interior build-outs for the structure. And operational efficiency can support stronger margins, but lenders will still underwrite realistic expenses rather than assume a facility will just operate itself. Short-term rental agreements can create pricing flexibility. And many self-storage customers rent on a month-to-month basis, whereas unlike a commercial tenant who gets locked into, say, a 5 or 10-year lease, storage operators can potentially adjust rental rates much more frequently. And that can give an experienced operator greater flexibility to respond to, say, changing demand in their market or occupancy or inflation, and produce competitive conditions to keep their buildings full. Now, however, lenders will typically distinguish between sustainable rental income and aggressive revenue assumptions. In a financing request that's based heavily in future rent increases without any historical support showing it's possible may receive a little bit more scrutiny. And self-storage serves multiple sources of demand. And another potential strength is that storage demand can come from many different customer segments. And consumers may need storage because they're moving or they're relocating or they're downsizing or because of marriage or because of divorce, or if there's a home renovation, or if kids going to college, or if there's a military deployment, or if there's a transition in the household, or if just there's a lack of residential storage. And businesses may use storage for their inventory or their equipment or their documents or their tools or supplies or seasonal merchandise. And this diverse customer base can make a well located facility less dependent on a single industry or tenant. So, why location and supply still matter? Well, self storage may be lender friendly, but that doesn't make every self storage deal financeable. And local supply and demand are going to matter tremendously. And a lender may evaluate population growth and household density and demographics and competing facilities and new construction and occupancy trends and what they perceive to be achievable rents, but also traffic patterns, visibility, and access. And one of the biggest risks is oversupply. So if multiple facilities are built within the same trade area, operators may have to compete aggressively for their customers. And that you can see through discounted rents and concessions. And that can pressure occupancy, but also revenue and ultimately the NOI that you're trying to generate. And strong historical property performance therefore needs to be evaluated alongside with what is happening in the surrounding market. So let's talk about stabilized self-storage financing. In a stabilized self-storage facility with established occupancy and consistent historical cash flow may have access to several potential sources for permanent financing. And depending on the transaction of the borrower and the property, and also the market options, that could include banks and credit unions and general commercial lenders and CMBS lenders, but also life insurance companies and debt funds and other private capital sources. And lenders will typically evaluate the property's current net operating income rather than simply accepting the seller's projections. So that is going to make more accurate financial statements and rent rolls and occupancy reports and trailing operating history extremely important to finance these. Value add self storage financing. And not every storage facility is going to be stabilized. An investor might want to acquire a property with below market rents and deferred maintenance and poor management and vacant units and weak marketing, but with great expansion opportunities, or maybe there's some other operational problems. And in those situations, bridge financing is probably going to be the most appropriate. And the investor can acquire the property and execute their business plan and increase occupancy and improve operations and grow the NOI and establish a stronger trailing operating history before the permanent refinance. And once the property reaches economic stabilization, the borrower can seek refinance into permanent financing. And the key is really having a credible exit strategy before taking on the bridge loan. So let's talk about self-storage construction financing. And ground-up development presents a little different underwriting challenge. And the property doesn't yet have operating income, so lenders really must rely heavily on the feasibility of the proposed project, but also the strength of the sponsorship. And a construction lender is going to examine the land basis of what you're paying for it, the construction budget, and the borrower's equity requirements or available equity, but also the developer's experience, and look at a market feasibility study where we look at existing completed supply and planned coming projects, but also the unit mix and the projected rental rates and the lease up assumptions and what we see stabilized NOI to be, projected value. Interest reserves, construction timeline, and exit strategy also matter. And a growing population alone doesn't necessarily justify another self-storage facility. And the lender is going to need evidence that sufficient unmet demand exists to support the proposed project. So what makes a strong self-storage loan request? And investors can improve their financing prospects by presenting lenders with a complete and well-supported package. So for an existing facility, that might include the current rent roll and the trailing 12-month operating statement, but also historical financial statements and occupancy reports. and borrower financial information, property information, and a clear explanation of their business plan. And for value add transactions, lenders will also want to understand exactly how the borrower does plan to increase the NOI. And for construction, having detailed budgets and feasibility information and plans and development experience, and also verified equity and realistic lease-up projections are going to become even more important for those. So the objective is simple. You want to make it easy for the lender to understand the property and the borrower and the risks, but also how the loan's going to get repaid. So why the right lender matters. And a strong self-storage property can still receive a disappointing financing proposal, excuse me, if it's been presented to the wrong lender. And commercial lenders are all going to have different geographic footprints and property preferences and loan size requirements and DSCR requirements and leverage limits, but also borrower requirements and different pricing models and different construction appetites. And bridge programs, as well as recourse requirements, are going to vary. So that's why comparing multiple capital sources can be extremely valuable. And rather than assuming that your bank has automatically knows the best lender for your self-storage transaction, it's better to work with a broker, and investors can benefit from evaluating multiple potential financing structures. So how CommLoan helps investors. Well, CommLoan is really going to essentially be your point to connect commercial real estate borrowers with lenders through our technology-enabled commercial lending marketplace. So for a self-storage investor, that means the financing search can be approached based on the specific property and the loan request and your borrower profile and the business plan, rather than forcing your transaction into one lender's credit box. Whatever the strategy involves, acquiring a stabilized facility or refinancing existing debt or repositioning an underperforming property or financing a new development, identifying the right lenders that understand the asset class can make a really important difference. So the bottom line for the day is that lenders don't love self-storage simply because there are rows of storage units sitting on valuable real estate. They like the well-performing self-storage deals because the asset class can offer really diversified rental income and scalable operations with flexible pricing and broad customer demand, and potentially very durable cash flow. But fundamentals still rule, and occupancy still matters, and NOI matters, and your DSCR matters. But also the market supply matters, and sponsorship matters, and lender selection really matters. So if you're evaluating a self-storage acquisition or a refinance or a value add project or a development, let's consider reviewing your financing strategy before committing to the transaction. Remember, the right capital structure can be just as important as finding the right property. Thank you for watching. That's it for the day. You can visit my website at billrapp.commloan.com. I appreciate your time. Take care.